In the United States, you can declare bankruptcy and discharge credit card debt, medical debt, gambling debts, and even certain tax debts under specific conditions, but not student loans. That exception was not always in the law. Someone put it there, and it was not students. Here is a fact that sounds too strange to be true until you look at the history. Student loan debt is the only major consumer debt category in the United States that cannot, in most circumstances, be discharged through bankruptcy. Not credit card debt, which can be discharged. Not medical debt, which can be discharged. Not personal loans, not car loans, not most other forms of consumer borrowing. Student loans, specifically. This exception was not always part of the bankruptcy code. Federal student loans first received partial bankruptcy protections in 1976. Those protections were extended and strengthened through subsequent legislation in 1990, 1998, and 2005. By 2005, both federal and private student loans had been given the kind of bankruptcy protection typically reserved for obligations like child support and criminal fines. The question worth asking is, why? What distinguishes a student loan from a credit card balance? Both are unsecured debt. Neither involves collateral that a lender could repossess if the borrower defaults. The answer the law arrived at, over several legislative steps, with significant lobbying input from financial institutions, is that student loans are different. By the end of this video, you will understand exactly why the law decided that, who benefited from that decision, and what it means for every borrower currently carrying a balance that the system was not designed to relieve. To understand how this happened, you need to understand why the bankruptcy exception was introduced in the first place. The original stated rationale, in 1976, was concern about abuse, specifically, that students might obtain a degree, immediately declare bankruptcy to discharge their loans, and then benefit from the higher earning potential of that degree without ever repaying the debt that funded it. This is a real concern in theory. In practice, research conducted after the fact has found no meaningful evidence of widespread abuse of student loan bankruptcy discharge occurring before the restrictions were introduced. The perceived problem was, at most, marginal in scale. The legislative response was significant. The 1998 tightening of these restrictions removed the previous requirement that loans be at least 7 years old before discharge would be considered, effectively closing what had been a limited pathway for long-struggling borrowers. The 2005 Bankruptcy Abuse Prevention and Consumer Protection Act extended the same restrictions that had applied to federal student loans to private student loans. Loans made by private financial institutions, for profit, at market interest rates, with no government guarantee of their underlying quality. Before 2005, private student loans could be discharged in bankruptcy like other unsecured debt. After 2005, they could not. The lobbying effort surrounding the 2005 Act has been extensively documented by researchers and journalists studying that legislation. Financial institutions with substantial private student lending operations were among the most active participants in advocating for the provision that extended bankruptcy protection to private loans. What they obtained through that legislative process was remarkable from a lender's perspective. A loan product with no collateral, issued to borrowers with no credit history and uncertain future income, made legally more difficult to discharge than almost any other consumer debt product in existence, including some secured loans where lenders have actual collateral. The risk profile of the borrower remained high. The legal recoverability of the debt became nearly absolute. That combination is extraordinary from a business standpoint. It was created not by market forces, but by legislation. Now let us follow the money. Because the student loan system, as currently structured, generates substantial revenue for a specific set of institutions, and the design of the system directly serves those revenue streams in ways that are worth naming clearly. Start with the federal government itself. Federal student loans, unlike most government programs, are designed to generate net revenue for the federal budget. The interest rates on federal student loans are set by Congress based on Treasury borrowing rates plus an added spread. The Congressional Budget Office and independent researchers have repeatedly found that the federal student loan program generates a positive return for the federal government over the life of loans, meaning the government collects more in interest than it costs to administer and fund the program. The scale of outstanding federal student debt, over $1.5 trillion as of recent years, means that even a modest interest rate spread generates significant annual revenue for the Treasury. This creates a structural dynamic that complicates the politics of broad loan forgiveness more than most discussions acknowledge. Forgiving outstanding debt at scale means forgiving future interest revenue that the federal budget is currently counting on. That is a real budget cost, even if the original loans were funded at low cost. Now consider the private student lending market. Private student lenders, operating with the bankruptcy protection obtained in 2005, hold a portfolio of debt that is more legally secure than almost any other consumer lending product they could hold. The default risk is not eliminated. Borrowers can still stop paying, but the avenue for permanent legal relief that bankruptcy provides for other debts is largely unavailable to these borrowers. That legal advantage directly increases the value of private student loan portfolios to investors in asset-backed securities markets, where these loans are packaged and sold in ways similar to mortgage-backed securities. Student loan asset-backed securities are a significant market precisely because the bankruptcy exception makes the underlying debt more reliably collectible than otherwise equivalent unsecured consumer debt. Then, there are the loan servicers, companies that manage the administrative relationship between borrowers and their loans, collecting payments, processing applications for income-driven repayment plans, and handling communication about loan status. Loan servicers are paid per account they manage, regardless of how long the borrower takes to repay. A longer repayment period means more months of servicing fees per borrower. Income-driven repayment plans, while genuinely helpful in managing monthly cash flow for many borrowers, can extend repayment periods dramatically, generating more total servicing revenue while the borrower pays more in total interest over a longer time horizon. The system does not need anyone to be acting in bad faith for this dynamic to operate. It just needs the incentive structures to remain as they are. Borrowers in extended repayment, servicers collecting per account, private lenders holding bankruptcy-protected debt, and the federal government counting interest as revenue. Every component of the system benefits from the debt remaining outstanding and in repayment for as long as possible. That is not a conspiracy. That is just how the incentives align. If the incentive alignment we just covered changed how you think about why broad forgiveness is so difficult to pass, stay with me. Because understanding who profits from the system as designed is one thing. Understanding the specific political and legislative dynamics that have blocked meaningful reform for decades, and what borrowers can actually use right now inside the existing system, that is what comes next. Here is an honest analysis of why broad student loan forgiveness has been politically difficult, despite significant public support. First, the budget cost is real and substantial. The outstanding federal student loan balance is measured in the trillions. Forgiving a meaningful portion of that balance has a genuine, large, immediate budget cost that must be accounted for under standard budget scoring rules, even if the underlying policy rationale is sound. This is not a manufactured objection invented by opponents. It is a real fiscal constraint that any forgiveness proposal must confront. Second, the political coalition against broad forgiveness is broader and more complex than just financial industry interests. There are genuine policy debates among economists about whether broad forgiveness is well targeted at the people who most need relief, versus being a relatively regressive policy that delivers large benefits to higher-earning professionals with advanced degrees. These are legitimate analytical disagreements, not purely cynical opposition. Third, the legal authority for executive action on forgiveness has been deeply contested. Multiple large-scale forgiveness attempts through executive action have faced legal challenges, and courts have struck down or substantially limited several major proposals on grounds related to the scope of executive authority involved. Fourth, and this is where the financial industry's influence does become directly relevant. The private student lending industry has actively lobbied against proposals that would restore bankruptcy discharge rights for private student loans. Restoring those rights would most directly and immediately benefit borrowers holding private loans, and it would not require any federal budget outlay. It would simply remove the extraordinary legal protection that was added in 2005. The sustained resistance to even this narrower, budget-neutral reform illustrates how concentrated the financial interest in maintaining the current structure is, and how that concentration affects the political durability of a provision that polls consistently show a majority of the public has never been clearly informed about. Most people do not know the history of how the 2005 bankruptcy provision was added. Most people do not know the provision exists at all. That informational gap is not an accident of public attention. It is a consequence of who has resources to shape what the public conversation focuses on. Inside the system as designed, that borrowers can actually use, there are several options. First, income-driven repayment plans. Federal student loan borrowers have access to repayment plans that cap monthly payments at a percentage of discretionary income, typically 5 to 10%. Under these plans, any remaining balance after a set repayment period, typically 20 to 25 years, is forgiven. The forgiven amount may be taxable as income, depending on the year. However, for borrowers carrying very large balances relative to their income, this pathway represents genuine eventual relief. Second, public service loan forgiveness. Borrowers working for qualifying nonprofit or government employers, while making 120 qualifying payments on an income-driven plan, are eligible for complete forgiveness of their remaining federal loan balance. The program has historically had significant administrative problems. However, recent improvements to its processing have increased the number of borrowers successfully receiving forgiveness. Third, for borrowers with private loans specifically, some states have consumer protection statutes, and some private lenders have hardship programs that, while not equivalent to bankruptcy discharge, can provide meaningful temporary or permanent relief in documented cases of financial hardship. Fourth, for any federal borrower, understanding which repayment plan applies to their specific situation and ensuring they are enrolled in the most favorable available option is worth the research time it requires. The difference between the standard 10-year repayment plan and an income-driven plan can be hundreds of dollars per month in a constrained budget. The tools are not perfect. They were not designed with borrower relief as the primary goal. But they exist, and knowing they exist fully is the first step toward using them effectively. Student loans became bankruptcy-proof through a specific legislative process over several decades, with significant input from the industries that benefit from them remaining that way. The history does not make the debt disappear, but it does make the system legible. And a legible system can be navigated more effectively than an opaque one. The tools that exist inside it are real, even if the system they sit inside was never designed primarily around your relief. Share this with one person currently making student loan payments, who has never heard of income-driven repayment or public service loan forgiveness. And if you want to keep understanding the financial systems built around your situation, subscribe to Hidden Truth Files. Hidden no more.